Thank you, Mr. President. Mr. President, the House of Representatives has just passed H.R. 3606, which is styled as a capital formation bill, but it is fundamentally flawed. As more and more people have looked closely at the bill, they have found more and more problems. Problems that could roll back key consumer protections and cause entire financial transactions and financial entities to go dark. One of the fundamental misconceptions in this bill is that you can have robust capital formation without good investor protections. My view is you can't have one without the other. That the strength of our market is the reliance that investors have that they will have the right information, they will know enough about the entity they're investing in to make judicious, sound economic judgments. This proposition would roll back many of those investor protections, would deny them critical information that is essential to make sound judgments, and would ultimately not lead to the supposed goal of the bill, providing more access to capital, particularly for small emerging companies. Serious concerns have been raised about the Cantor bill by current and former regulators in the last 2 weeks. Mary Shapiro, the chairman of the Securities and Exchange Commission, the North American Securities Administrators Association, Arthur Levitt, former chairman of the SEC, the head of the American Amex, Lynn Turner, former chief economist of the SEC. Some of the largest pension plans in the entire country have been weighing in through the Council of Institutional Investors. And these are the entities most people want to have invest in their companies as long-term investors. They have real concerns about the House action. We've been getting phone calls and letters from a variety of consumer groups such as the AARP, the Consumer Federation of America, the AFL-CIO, and SAFER, the Economist Committee for Stable, Accountable, Fair, and Efficient Financial Reform. Academic experts like Professor John Coffey of Columbia University School of Law, for one, have called the Cantor bill the, quote, boiler room preservation act, close quote, because it will mean more pump and dump schemes where people are being pressured to invest in highly risky firms and products. Two other noted securities experts from Harvard University Law School and Business School, respectively, John Coates and Robert Posen, have said the bill does more than, in their words, trim regulatory fat, parts of it cut into muscle. We need to slow down this process and get it right. H.R. 3606 can be improved and should be improved. That is why I, together with colleagues, Senators Mary Landrieu and Carl Levin and Sherrod Brown, Jeff Merkley, Senator Dannakaka, my colleague from Rhode Island, Sheldon Whitehouse, Senator Franken, Senator Harkin, Senator Durbin, and others are introducing a substitute amendment to this bill today. We hope that our legislation can serve as a base bill for the Senate to discuss and amend as we move forward. So what are some of the most serious faults that we are trying to address in the Cantor bill? First and foremost, this bill is unlikely to create jobs, despite the title that the House has bestowed upon it. In fact, it may actually have the opposite effect. By weakening investor confidence, it could actually decrease the number of IPOs and lead to fewer investments in our capital markets. Currently, our markets are considered the most transparent and liquid in the world, which have been one of its great strengths. The confidence that when an investor puts money into an American financial product, an American market, he or she has detailed information about the current status and the prospects of that investment. Under the Cantor bill, our markets will become less transparent, more opaque. Fewer protections will be provided to investors. This could actually lead to fewer investors investing in the United States, since we are in an increasing competition in a global economy with capital markets in London, Paris, Hong Kong, and Singapore, to name just a few. Again, one of the great hallmarks of our markets, starting in 1933 with the securities legislation of the New Deal, was the feeling that investors would be protected, that there would be standards in place, information would be made available to them, and they could have confidence, as much confidence as they could get in their investments. And when you undermine that confidence, eventually you will undermine both their appetite and capacity to invest. The Canada bill has more problems. It tries to create a way that crowdfunding can be used to raise money for small enterprises, but it does this with very few protections for investors and would allow unregulated websites to peddle stock to ordinary investors without any meaningful oversight or liability. Crowdfunding is a very interesting new approach to raising capital. Our colleagues, Senator Merkley and Senator Bennett, have spent a lot of time developing very positive legislation which balances the access to capital by tapping into social networks and small investors, but at the same time giving those investors adequate protections. The House has not taken this approach. They have legislation that could indeed create a situation where crowdfunding is plagued by fraud, by manipulation, by people who simply want to make a quick buck, move on, hoping that they will just disappear into the internet. Now, the Craigslist or eBay model may work to enable people to sell unwanted clothing, bikes, and other goods, but it certainly doesn't work for financial security that requires a much more careful analysis than simply kicking the tires. People with more credit card debt than savings will be tempted with these mass-marketed get-rich schemes to put their money, which they can't afford in many cases, into these schemes. As the economy continues to grow, stocks will rise. We've seen some interesting and very positive developments on Wall Street over the last several weeks, but this ride up could be accompanied by bubbles in these types of crowdfunding schemes where people are putting money in for a quick return based on perhaps the success of one or two companies, but not having the information, not having the appropriate controls on the intermediaries so that they can make a sound, valid investment. There's another aspect of the House legislation in addition to this crowdfunding approach. It's the House IPO on-ramp aspects. This approach, an IPO, of course, is initial public offering. This approach to try to streamline access to the public markets for emerging companies has great merit. But once again, what has happened in the House bill is that they've done this at the expense of necessary protections for investors. Relaxing standards for very large new public companies when no effort supports that idea that those standards stand in the way of these IPOs, and much evidence suggests that the standards prevent serious accounting problems, is not the way to go. The basic essence of their approach, this on-ramp approach, is very large companies with up to $1 billion in revenue can, for a period of 5 years or so, avoid some of the now standard requirements for public companies. This is not an approach for small companies. Companies with $1 billion in revenue are substantial economic enterprises. And the protections that have been put in place over the years, not only to protect the investors, but also to ensure the appropriate audit procedures that are in place, to ensure appropriate managerial behavior, for a company of that size, should not be indefinitely waived or waived for a period of 5 years. We could go back, literally roll the clock back, pre-Enron, pre-WorldCom, where because of a creative accounting, because of the lack of adequate audit procedures within the company, real abuses. And the result was Enron collapsed. Their shareholders were left with virtually nothing. And one of the more tragic ironies is that many of their shareholders were their employees who had all of their pensions invested in the company, particularly the case with Enron. Ultimately, the pain to these people caused by lack of good standards, which have been put in place since then, was significant. And we if we proceed on this path, might once again have a situation where we're repeating history, and a history we've seen already. Now again, as the economy rebounds, as stocks rise, I think there'll be an invariable increase in new initial public offerings, IPOs. If you look at the data, the numbers of IPOs go up and down, but the most significant factor is simply economic activity. As economic activity goes up, new companies have opportunities, IPOs go up. In this boom, there could be the temptation for these companies, given these new, very relaxed standards, to ignore the problems because they don't have to disclose them adequately, or to deliberately mislead investors because there's no real check on what's being said. The relaxed standards in the House bill could allow companies to engage in deception, to raise and waste more investment money more quickly. There is a way, I think, that we can dial back this excessive legislation in a way that will provide capital formation, but will also provide protections to investors. And I hope we can proceed in that path. Now, increasing IPOs is a valuable goal, but it should be done much more cautiously in my regard, with reforms focused on much smaller companies than those with $1 billion in annual revenues, as is indicated in the House bill. Now, during the course of 3 hearings in the Senate Banking Committee on these issues, it became even clearer that there are problems with the way shareholders are being counted. And this is another aspect of the House bill. They have indicated that they would like to move beyond a number, 500, which requires a company to register under the 1934 Securities Exchange Act with the SEC. This trigger is something that should be considered in terms of present-day standards. The House bill raises this trigger point to 2,000 very quickly without dealing with the so-called beneficial owners problem. If the provision in the House bill was enforced in the past, 2/3 of current public companies would not have been required to register under the 34 Act. Let me say that again. If you reach a certain number of shareholders, you're required to begin to register and begin to give those shareholders required information on a quarterly basis. You're required to file other forms. You're required to be subject to other rules and regulations of the SEC. If this House standard was in place, 2/3 of current public companies would not have to register with the 34 Act. They would be operating in the dark. They would be operating with whatever minimal information they might be required to divulge to their shareholders under state corporate law, or in some cases state securities laws. That is an astounding number of companies. Most investors take for granted that when you reach a critical size, number of shareholders, et cetera, that you'll begin to report. And again, these reports are the lifeblood, if you will, of the investing community, because they rely upon them for their information about what's going on in the company. They rely upon them for the standards that company has to follow. Over time, most investors, as a result of registration of the 34 Act, are entitled to receive regular disclosures. And again, these provisions, raising up the level to 2,000 owners, would undermine the goal, which is essentially making companies easier to go public, easier to disclose information. In fact, someone described this as sort of a bipolar piece of legislation. On one hand, they want to relax the standards to get public, and on the other hand, they want to relax the standards to get private. I think we have to be careful in each instance to ensure that investors are protected as well as capital formation is enhanced. The House would also allow companies to, the House bill rather, would also allow companies to advertise risky, less regulated, unregistered private offerings to the general public using, for example, billboards along the highway, cold calls to senior living centers, or other mass marketing methods. It'll tear down protections that were put in place after the late 1990s internet stock bubble burst that prevented conflicts of interest from tainting the quality of research about companies. What we found in the wake of the dot-com bubble, with many protections in place that would be taken out by this legislation, that there were analysts who were touting companies at the same time other parts of their business were trying to sell those company shares. And this conflict of interest between someone who you hope is given an objective opinion would be encouraged, not discouraged, under the House bill. The Canada bill would allow extremely large corporations to avoid SEC oversight. It would allow banks with even hundreds of billions of dollars in assets to deregister and stop being subject to SEC oversight and critical investor protections. And finally, the Canada bill actually doesn't include provisions that are more likely to create jobs for Americans. For example, the House bill does not include authorization of the exempt bank. Time is the essence, by the way, to get this exempt bank reauthorized. The bank's temporary extension expires at the end of May and is close to exceeding its operating level of $100 million by the end of this month. Renewing the exempt bank's charter with increased lending authority is the only way, practically, of countering the predatory financing practices of other trading nations. We spend a lot of time on this floor pointing the finger at companies that are using their sovereign institutions to undermine American jobs, to get them overseas, and yet one of the major institutions in our country that helps American products to be sold overseas is in danger, literally, of going out of business. That's something that will, in fact, enhance job creation. It's not in the House bill. In fact, it's been suggested that exempt bank activity supports almost 300,000 jobs in the United States each year. It also doesn't include two other programs that result in more jobs, and these two programs are particularly the result of the hard and aggressive and thoughtful work of Senators Landrieu and Snowe. They worked on the extension and expansion of the capacity of the Small Business Administration's venture capital program, the Small Business Investment Company Program specifically, SBIC. They have proposed legislation that would allow another $1 billion in equity-like financing for smaller, fast-growing firms, and it also extends for 1 year the SBA's 504 refi loan program to help firms refinance commercial real estate to long-term fixed-rate loans. These modifications have created and saved hundreds of thousands of American jobs at no cost to the taxpayer. These are tried and true ways to increase jobs here in America without running the risk of undermining the information that investors need to make sound choices about where to invest their dollars. Now, it is very tempting to suggest that we simply have to cut a couple of regulations and jobs will expand. That was a theme that was rampant here during the Bush administration. And for a while, frankly, it looked like it was working. But then with the sudden and colossal collapse, we knew that was not the path to long-term sustained job creation. Sound investment based on adequate information in companies that will produce jobs here in the United States is the way to proceed. We need to listen to those individuals charged with the supervision of our capital markets, the SEC, and now we have both the current chairman and a former chairman saying the legislation the House proposed is a threat to all of the investors in this country. The stakes are high if we get some of these things wrong. We've been trying to focus on these issues intensively for the last few months to bring legislation to the floor that will balance capital formation with investor protections. You can't, I think, get one at the expense of the other. You have to have both. So I would encourage all my colleagues to take a very close look at the Reed-Landrieu 11 substitute. I believe it's a substantial improvement of the House bill, and I believe my colleague from Louisiana will speak. And once again, I must commend her passion to protect investors, particularly small investors, and her passion to create jobs through the SBA and other agencies is both remarkable and commendable and indeed exceptional. And with that, Madam President, I will yield the floor.